The second model we will discuss in this week is one you should have already seen, even if you don't know it by this name, and that is the liquidity preference model. It is standard fare in introductory macroeconomics classes. As we had discussed in the second week, credit instruments and money, understood as the medium of exchange, are substitutes in terms of savings. For that reason, interest rates are related to the market for money as well. The fundamental trade-off here is one between foregone interest and higher liquidity when you're holding money versus a bond. Notice that bond returns typically are also subject to inflation. So the argument that inflation reduces the value of money while it doesn't reduce the value of bonds is generally incorrect, although there are some instruments that also adjust for inflation. It's not the standard case, however. The core trade-off is then generally one between interest and liquidity. Now, the liquidity preference model explains the relationship between money and interest-bearing assets like bonds based on this trade-off, and it has its origins in the original Keynesian model and its interpretations. Since the model describes a simultaneous equilibrium in several markets, it is considered a general equilibrium model in contrast to the single market loanable funds model, which is often referred to as a partial equilibrium model. To keep this model simple, assume that there are only two ways to save, bonds B and money M. In practice, economists and financial practitioners refer to a risk-free interest rate in this context, which in a country like the US is typically the 3-month treasury bill or some other type of short-run government-issued bond. These are highly liquid and virtually default-free, so the interest rate they pay vis-a-vis money mostly reflects the lower liquidity. That aside, general equilibrium requires that the value of demand for money and bonds, the total value of demand for money and bonds, needs to equal total wealth, which in turn needs to be equal to the total value of the supply of money and bonds. Notice that the important word here is value, so don't think of this in terms of volumes. The adjusting factor in general equilibrium models can be both price and or quantity. These quantities therefore represent nominal values. Now, formally what I just said simply means that MD plus BD, total demand for money and bonds expressed in dollars, needs to equal BS plus MS, total supply of bonds and money in terms of dollars in equilibrium. I can slightly rewrite this, and this will give us more intuition, as MD minus MS needs to equal BS minus BD, simple algebra. Now, what does general equilibrium imply for partial equilibria in each the bond and the money market? Well, if the bond market is in equilibrium, that means BS equals BD. The money market needs to be in general equilibrium as well, i.e. MD needs to equal MS. If that's not the case, the general equilibrium condition I just showed you does not hold, and things will be shuffled around. Intuitively think about it the following way. If you have $1,000 and you currently are holding $200 in money and $800 in bond, your equilibrium holding of money can only be $200 if your equilibrium demand for bonds is $800 as well. If you wanted, say, $900 worth of bonds instead, you have to buy them by giving up $100 of money, so $200 cannot be your equilibrium demand for money. Now, this pattern is a little abstract, but it holds for any number n of markets, and it is generally known as Walras' law after Swiss economist Leon Walras. And what Walras' law states technically is that if out of n markets, n minus 1 are in equilibrium, the nth market must be as well, or else you are not in a general equilibrium situation. So in this case, if out of 2 markets, 1 is in equilibrium, so must be the other. This is a point that is discussed in some more detail in intermediate macroeconomics and in tedious detail in grad school. I won't write it too much here, just know that this is the basic substitute logic underlying the model that's about to follow. For our purposes, Walras' law simply implies that whatever interest rate reflects an equilibrium in the bonds market must also be the interest rate at which the money market is in equilibrium. This conveniently allows us to discuss how changes in money supply and demand then affect the bond market and equilibrium interest rates. Again, I understand this setup sounds a little bit abstract, but the model itself is nearly as basic as the loanable funds model, and as mentioned before, you should have seen it before. Let's start with a discussion of money demand. Money demand overall depends on three factors. Number one, interest foregone. Foregone interest is the opportunity cost of holding money. When you hold money in your bank account or in your wallet, you're losing out on interest you could make on a bond or a savings account. The higher this opportunity cost, the more agents, all else the same, will want to economize on their money holdings. So part of the reason why you probably don't think much about this is because we live in an environment in which interest rates are very low. Right? Your savings account basically pays you nothing. If you've lived in the 1980s where interest rates were closer to 15%, it's a pretty dramatic difference. That's what this first point illustrates. Number two, transactions volume. In the aggregate economy, the more we buy stuff, the more money we need, all else the same. And the more we produce, the more transactions we make, the more money we need to make these transactions. As a proxy, money demand then increases roughly proportionally to real GDP as an indicator of overall transactions volume. This is a little bit simplifying because a dollar can be used more than once in a given time period. But for our purpose, the general notion that if GDP increases, transactions demand and money demand will increase is sufficient. Number three, the price level. As things get more expensive, we simply need more money to buy the same amount of things. In the aggregate, therefore, if the price index as measured by the CPI, or for instance, as measured by the deflator, increases, money demand will increase as well. Point 2 and 3 are sometimes taken together by saying that if nominal GDP increases, money demand increases as well. Now, it is customary to illustrate money as a negative function of the interest rate, in part because we are primarily interested in equilibrium interest rates in the first place. And this takes us to a graph that should look familiar. As interest rates fall, the amount of money that agents hold in their checking account and wallets will increase. An increase in GDP, an increase in the price level, meanwhile, would shift this graph to the right. A decrease would shift this graph to the left. Notice one important point, and it's one that I test a lot. The interest rate is not the price of money. I understand this looks exactly like a demand curve in a partial equilibrium model, but this is not a partial equilibrium model. The interest rate is the opportunity cost of holding money in a substitute market, namely the market for bonds. It is determined by supply and demand for bonds, not directly by supply and demand of money. So don't write that or don't memorize that because it's wrong. Now, when it comes to money supply, we're making a simplistic assumption, namely that the money supply is simply set exogenously by the central bank. Central banks in practice do not randomly adjust the money supply around, but it simply pays credit to the fact that they also don't mechanistically respond to changes in the aggregate economy. Rather, the money supply is a discretionary policy variable, and this is the meaning of these exogenous assumptions. If I'm drawing it as a function of the interest rate, you might remember that, I'm getting a straight line that is parallel to the vertical axis in the graph. The money supply does not automatically adjust to the interest rate in the way the money demand does. Now, equilibrium then is, as always, given where money supply equals money demand, and the equilibrium point E0 corresponds to the equilibrium interest rate in the bonds market, and that follows from Walras' law. Right, so this you have seen before. Money supply equals money demand. Put it to intersect, you get an equilibrium interest rate. The only reason why we know that this is the equilibrium interest rate is Walras' law. If money supply equals money demand, bond supply needs to equal bond demand. That means whatever prices prevail in the bond market, whatever yields prevail in the bond market, are equal to the equilibrium yield. Now, as you probably know, this is the most conventional model for explaining monetary policy, and we will use it a little bit for that. It's not entirely uncontroversial because it has limitations when the interest rate becomes very close to zero, which of course is an environment which we currently live in. However, if that's not the case, and we'll talk about the exceptions at a later point, the standard wisdom is that an increase in the money supply decreases interest rates. This is so broadly accepted, in fact, that news reporting on monetary policy typically skips the money aspect of things altogether. Rather, news outlets report on the Fed lowering or raising interest rates instead. In practice, the mechanism works through open market policies. For instance, in an open market purchase, a central bank buys bonds and pays with money. By contrast, in an open market sale, a central bank sells bond and takes money off the market. The typical instrument for these are treasury bonds, and notice that central banks themselves do not issue bonds. They also typically don't buy them from the treasury directly. Rather, they buy them from bond traders or banks in the open market, hence the name. Now, if a central bank buys bonds, it puts money in the market, the money supply increases, but at the same time, it takes bonds off the market, so the bond supply decreases. And this, as we'll see in a second, has implications on that Boller's law substitution logic. For instance, in this diagram, if we're starting at equilibrium E0, money supply 0, if the Fed buys bonds, it would increase the money supply to MS1. And at the old interest rate here, you now have an excess supply of money that is equal to this difference, right? It's MS1 minus MS0. If that's 100 billion, it's an excess supply of 100 billion. At the same time, in order to get that money in circulation, the central bank had to buy bonds worth an equivalent amount. So if that was 100 billion, now there's 100 billion fewer bonds in the market. Right? That creates an excess demand for bonds worth 100 billion. We know this because at E0, both markets were in equilibrium. So if the money supply increases by 100 billion, if there's an excess supply of 100 billion here, it must be met by an excess demand for bonds of an equal amount in the bond market. Now, if there is excess demand for any good, the price of that good will start to increase, and the same thing happens here. There are now fewer bonds in circulation, so the price of bonds increases. That drives down the interest rate. We move down the money demand curve until we reach a new equilibrium.